If you're currently in your 20s and looking to dip your toes into the world of investing, well then you found the perfect video. Investing in your 20s is a smart move, and because you're relatively young, focusing on more growth-oriented ETFs can be an excellent strategy. But especially a lot of newer investors don't know which ETFs they should consider. But in this video, we are going to go through one of my favorite growth-oriented ETFs that I think could be a potential perfect option for a young investor with a long time frame ahead of them. Now stick around because you are definitely going to want to learn more about this growth ETF as it's had massive returns so far. Now we're going to go through all this and more. Right after you, please drop a like in this video and subscribe for more future content like this. Now before we go into exactly which ETF I'm talking about and all the ETF has to offer, let's talk about why anyone at all should even start investing in their 20s. And the answer to this, simply put, is that time is on your side. When you start investing early, the younger the better. You have the advantage over older investors because you can work with the power of compound interest. This means that the money you invest has more time to grow, potentially turning even small contributions or deposits over time into significant wealth in the long term. Additionally, in your 20s, because you have such a long time frame ahead of you, you can afford to take a little bit higher risks. And because of this, you're able to weather market fluctuations and take advantage of higher risk, higher reward opportunities like the growth ETF we're going to go through. Now, the growth ETF that I think would be a perfect candidate for anyone and their investors to look into and possibly invest into is the Schwab US Large Cap Growth ETF, or SCHG. And in the last 14 years is up over 488%. Just year to date, this ETF is up over 36%. In the last 5 years, up over 88.65%. Now, SCHG is currently trading at $75.22 per share, which is pretty close to the 52-week range high. But for long-term investors, especially if you're in your 20s, it wouldn't really even necessarily matter all that much when you buy into an ETF like this, because as you can see, historically speaking, even after some pretty big drops, this ETF has pretty much always recovered and kept moving up and to the right. Now, before we go any further, let's dig a little bit deeper into the SCHG, the Schwab US Large Cap Growth ETF, learn more about it and see what it has to offer. So first, one thing that stands out to me is the total expense ratio is just 0.04%. Now, generally speaking, anything below, I would say 0.1% is a relatively cheap expense ratio, but 0.04% is one of the cheapest expense ratios across any ETF in the market. Which means for long-term investors like myself, holding onto this ETF long-term will not cut into too much of the profits later on. Now, it then says that the objective of the ETF is that the fund's goal is to track as closely as possible, before fees and expenses, the total return of the Dow Jones US Large Cap Growth Total Stock Market Index. Some more facts about the fund. The inception date was 12/11/2009. The fund is a passively managed fund, and the assets under management, the total assets, is over 18 billion. This ETF is up 469%, and that is just in the last 12 or 13 years. In the last 10 years, this fund is up 261%. And as we go through these different time frames, you can see exactly how much this fund has returned on an annualized basis. On the 5-year time frame, 83.31% return. Now, the 1-year time frame has been a little bit rougher because, of course, the drops that we saw in 2022 into 2023. But year to date, this fund is up 32.29%. And that's even after the recent small drop-off, where SCHG was trading at $78 per share just a few weeks back. Now, just to give some more context, the S&P 500 index, one of the most popular investments for pretty much any long-term investor, year to date has seen a 14.27% return, which generally speaking is very good. But once again, looking at the Schwab US Large Cap Growth ETF's year-to-date return, it's not even comparable. Now, digging into the exact reason on why this ETF has performed so well over the past 10 plus years, and definitely so well year to date, it's of course because of the holding breakdown. Now, this ETF has around 45% technology, which gives this ETF a higher beta than other ETFs out there. But if and when the market does turn bullish, technology stocks in general have a tendency to really move up in price very quickly, which is definitely partially how this ETF has seen so much massive amounts of return over the past 10 plus years. Now, the next biggest category is healthcare at 13.8%, communication at 12.8%, consumer cyclical at 12.1%. Financials at just over 6%, industrials at 3%, consumer defensive at 1.8%, basic material at 1.8%, energy at 1.5%, real estate at 1.1%, and utilities and cash under 1%. Now, when I show you the top holdings in this ETF, it's going to be very obvious on why this ETF has performed so well and why, in my opinion, of course I could be wrong, but in my opinion, why this ETF is going to continue to perform well long into the future. The top 10 holdings being Apple, Microsoft, Amazon, Nvidia, Alphabet, Meta, Tesla, United Health Group, and Eli Lilly. Now, of course, because SCHG does track the Dow large cap, there are going to be 245 different holdings in this ETF, which makes the ETF pretty well diversified, which for the most part doesn't really matter all that much when the top 10 holdings are companies like these, which once again, when the market turns bullish, these companies in general perform or have performed very, very well. Now, the Schwab US Large Cap Growth ETF does pay a very small dividend. And although the dividend score is honestly pretty bad considering the trailing 12-month dividend yield is 0.46%, the trailing 12-month dividend growth rate has actually dropped. And the 10-year dividend growth rate being 2.6%, which is much, much lower than what pretty much any dividend growth investor is looking for. The fact of the matter is that investors buy into this ETF because they want to see some growth. They want to see their portfolio grow in a relatively short amount of time very, very quickly. And for the most part, other than a few times in history during massive macro events, that's exactly what this ETF has been able to do. Now, generally speaking, when it comes to investing, younger people should consider taking bigger risks for several different compelling reasons. And of course, while risk tolerance varies from person to person, here are some of the key arguments for why those in their 20s should be willing to embrace risk in their investment strategy. Now, number one being time horizon. One of the most significant advantages young investors have over older investors is they have time on their side. Especially if you're in your 20s, you typically have several decades ahead of you before you even need to access any of the funds within the investment to use for things like life expenses or even retirement, of course. And because of this long time horizon allows you to ride out the inevitable market fluctuations and recover from any downturns that might happen from now till then. Number two is compound interest. Albert Einstein once called compound interest the eighth wonder of the world. Compound interest allows your investment to earn interest on both the principal amount and any previously earned interest. The longer your money is invested, the more the power of this compounding effect becomes real. Riskier investments may have higher growth potential, which when compounded over time can lead to substantial wealth accumulation. And lastly, number three, the ability to recover from your losses. Young investors have the luxury of time to recover from investment losses. So even if you were to make a risky investment that doesn't perform well initially, you have years or maybe decades to adjust your strategy, recover from those losses, and then hopefully see massive future gains ahead. So if you are currently in your 20s and have a long time frame ahead of you, investing into something like SCHG with a basket of stocks that definitely have massive growth potential, and of course looking at the historical performance the ETF has offered so far, could definitely allow a younger investor to see massive compounding returns long into the future. But it's also important to note, especially for newer investors, to do your own research, build a strategy that works for you, and of course, maybe most importantly, investing is a long-term game, but getting started early can definitely help. If you enjoyed this video, make sure to please drop a like on it and subscribe for more content like this in the future. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.